Why did the S&P 500 rally some 18–90% of these lows here? Has inflation peaked? Is the recession off the table? I will try to answer those questions in this video. The simple answer is no. On June 17th, a lot of options expired. It happens 4 times a year. It is called quad-witching. And whenever that happens, the market often tends to turn around if we've seen a big move into that event. When the market makes a big directional move into quad-witching, like it did here to the downside, market makers often get in trouble. There was a lot of demand for puts, so market participant bought puts left and right. The market maker sold them the puts, so the market maker was short puts. When then price comes down, the market maker is forced to sell into weakness to hedge their position. Until these options get off the book, there is a lot of selling pressure the market maker is causing, because every time we gap down, the market maker needs to sell into that weakness to hedge the risk. But on June 17th, these options expired, so the risk for the market maker was then off the table, and that is the reason why we bottomed on June 17th. After that, we saw a massive short squeeze. That is all what this was. Another factor we must consider are these local pivot points. Whenever there was a local low, it draws a red line. Whenever there was a local high, it draws a green line. These levels are important because a lot of traders use those to place their stops. For example, if you are short somewhere here, your natural position to place a stop would be above this green level. And everybody who was short somewhere here got stopped out when price went above that. And that is why this is a very, very important price level now. And if we cannot get back above 4200 or 4180-ish, the next move is going to be lower. Short-term price discovery has nothing to do with fundamentals. It is simply a consequence of positioning. The market is trying to find the way of least resistance, and it is usually the way of most pain. And the pain sometimes shifts from market makers to regular investors. On the way down, the pain was felt by market makers who were short puts. On the way up, the pain was felt by regular investors who listened to the pundits on TV who became way too negative. But now, everybody who was short somewhere in this area just got stopped out. So that pain is now over, which means a new cycle can now begin. The strategy I will use is pretty simple. I am waiting for a bounce above 4180, and in this area, 4180 up to 4220, I will open a short position and I will exit that if price closes above 4225. If it exceeds that level intraday, I do not care. But on a closing basis, I want price to stay below that. As long as that is the case, I will stay short until my target is hit. And the first target is pretty simple. I will exit the position if price gets close to that 4000 level. Then I will reassess. But I believe odds are pretty good that we will take out these lows here eventually. I will make another video if I either get stopped out above 4225 or if the target around 4000 is hit.